On today's episode, we are going to take a look at three sectors that are booming right now thanks to Pfizer releasing great news on their vaccine and how effective it is. So on today's episode, first we're going to take a look at each individual sector. We're going to look at some of their main players, and we're also going to look at historical data right now to see how the overall virus has affected their business. We can see right now, Dow ended up 800 points higher, almost 3% up on the day. So today's episode is going to be broken down into the following. First, we're going to take a look at each sector individually. We're also going to look at some of the top players in those sectors, and we're going to look at historical data to see how much COVID has affected their business. Like that, we understand how much they need to improve so they can go back to the levels they were before. Like always, my name's Jose Najarro. By day, I'm a senior electrical engineer, but by night, I'm a self-taught investor looking for investments to hold for the long-term gains. If you're new to the channel, make sure to hit the subscribe button and don't forget to hit the thumbs up. It helps the channel out so much and I truly appreciate it. Remember, none of this should be taken as advice as I am not a professional. And before we go any further, I also have three more sectors after these three. And if you guys want to see those sectors, make sure to let me know on the comments below. And while you're down there in the comments below, you should see a link to Discord channel. It's free to anybody that wants to join. I post every time I buy and sell. And we have a great community of over 1,000 members right now. Also down there, you should see a link to Weibo. If you sign up following those rules, we both could get a free stock. Sometimes they even do specials where we might get 2 to 3 stocks. And don't forget to check out the merch. You should see it down below. So the first sector we're going to take a look at is obviously the airline sectors. I'm pretty sure most of you would have put this in the map. And also at the end of the video, I'm going to give my thoughts of if I'm buying any of these sectors right now. So the main player here I'm going to choose is Delta Airline, and we're going to look at their historical data to see how things have really been affected due to COVID. So right now, year to date, Delta Airline has returned about negative 37% to investors. So even after today, which it rallied up 17%, congratulations to anybody who picked up at the low, or even just yesterday, right? You're up 17%, so congratulations to that. But we can see right now it is still down. It's still 1/3 of its value less than it was at the beginning of the year. So let's take a look. Obviously, Delta Airlines and all the airlines have taken a huge hit with less people traveling, but let's see how much of a hit they've taken. So now let's take a quick look at their historical quarters right now. So in the quarter that ended in June, we can see that revenue dropped down dramatically. In March, it dropped down a nice amount, but June they took a huge hit, and then this recent one that ended in September gave a small increase. But revenue growth compared to the same time last year, this most recent quarter was still down 75% revenue compared to the same time last year. The quarter that ended in June was down 88% compared to the same time last year. And when all this started to take place, which was the end of March quarter, that was down about 18%. So we can see the most recent quarter is still down 75% compared to this revenue of last year. And that's a huge take. That's definitely something that can really move the business, and we can see why the stock price has dropped dramatically. So now the question is, can this company regain to its previous levels? But not only that, will it still be able? How much of it has changed? Has their balance sheet changed? Has their cash flow statements changed? And will those also be able to improve? So obviously, with that kind of revenue loss, they still have employees to pay, so their profit margins dropped dramatically compared to the same time last year. So profit margins, for example, were negative 175% on this most recent quarter, and then profit margins on the quarter of June was negative 389%. So we can see huge losses coming from the airline industry. One thing the revenue is definitely important to look at, but if businesses turn around, the revenue can pick up dramatically. That's not a thing. One of the major issues is the effect that loss of revenue has made in the business. And the main thing is, how much debt have they collected and how much assets have they grown compared to those previous quarters? So the first thing I'm seeing is shareholder equity. For those that don't know, shareholder equity is total assets minus total liabilities. So obviously, if you have a lot more assets than liabilities, your shareholder equity is a lot higher. Here we can see shareholder equities continues to decrease in the past 3 quarters. Right now, in this most recent quarter that they reported, their shareholder equities are as low since I want to say 2013. And that means that this company has collected a lot more debt than assets in the past few months. And let's take a look at where that liability is coming from. We can see here a lot of that debt is coming from non-current debt. The United States has helped out to some extent, giving some form of PPP loans. They've also done some other forms of transactions, but look at this huge growth of non-current debt for Delta. And this is one of the few airlines who had one of the better balance sheets. So I can't imagine how the other airlines are doing. We can see about a year ago, they had about $13 billion in debt. Now they're sitting at about $36 billion in debt. And I do believe this is the major part that's going to affect, right? Obviously, revenue can come back up, but how long will it take for them to bring back this balance sheet to one of the greatest balance sheets in the airline industry where they usually were? I know Southwest was another one with a very, very strong balance sheet. Even though we see a huge increase in non-current debt, cash and cash equivalents did increase. They right now have about $16 billion in cash and cash equivalents. But remember, a lot of that is used to pay their employees, and they're gonna show that they have a lot of cash flow burning right now. So next, I wanted to take a look at just the net cash flow from operation, how this company is doing. We can see this most recent earnings, net cash flow from operations, were negative $2.5 billion. This is probably the lowest it's been since 2008. Same with free cash flow margins. Free cash flow was about negative $2.7 billion this quarter. That's how much money they are burning right now. That is insane. So, right, if one is thinking about investing in airlines, these are things you should take a note at, right? I'm not giving here a bearish sentiment. I'm not saying that these stock prices aren't going to go up. But as an investor, one should be aware of what they need to fix and where these fixes should come from to understand how this company will improve over time. So we can see that airline industry definitely took a big hit, and I can see why the stock price is still down about 38% compared to its beginning of the year. Another company in this market, it would be Southwest. There's plenty. There's American Airlines, there's United Airlines, JetBlue, Spirit, and all of them are probably up dramatically right now. Southwest is another one, ticker LUV, and they're up 9.7% for the day. But if we take a look at year to date, I'm not going to be surprised if it's similar values. We can see this one's down 20% from its year to date. But if we take a look at all-time highs, it's about 25% down. So Southwest is one with the better, I want to say with the best balance sheet out of all of them. So I can see why this one is not down as much compared to Delta. And before we go any further, down in my comments and description, you should see a link to 7investing.com, where every month they recommend 7 stocks for only $17 a month. If you use my promo code if you use my link or my promo code Jose, you get $10 off your first month. May I say, yes, this is an affiliate program, but I do use their services and would recommend it to anyone. The second industry we're going to take a look at is the more like entertainment and theme park industry, and to me the biggest player right now is Walt Disney. Walt Disney Company, it's ticker DIS. Right now it is up 11, almost 12% for the day. If we take a look at year-to-date returns right now, Disney is still down about 4%. But we can see, right, Disney does also have other aspects like Disney Plus, and I think that's mainly the main, and the toys and stuff. But remember, they deal with a lot of movies, and all the theme parks and the cruise lines are a big part of their business. So obviously they took a huge hit. Right now, they are sitting at $142, like I mentioned, up 12%. So let's take a look at how Disney has been affected. So Disney has not given their most recent earnings. I think it's going to be this Thursday. But we can see on their most recent earnings, which were for the end of June, their revenue has dropped a nice amount. We can see this big drop here. We can also see it is down about 41% compared to the same time last year. So it definitely took a huge hit as well. I do believe the streaming service is helping them a bit with the revenue growth, not taking a huge hit. So that's kind of offsetting that a bit. But we can see profit margins this recent quarter were about negative 40%. So this is definitely a company that has taken a hit. Now, if we take a look at their shareholder equity, has actually increased dramatically and not decreased like we saw with the airline industry. And we got to understand why that's happening. We got to be like, hey, Jose, has this company not taken debt? Yes, they have. But remember, they just started doing this Disney Plus membership subscription. And that alone has created a whole new asset line of intangible assets for Disney. So that's why we're seeing a huge headline up there right now in total assets. But we're also seeing a huge growth in non-current debt. So we can see I do believe a lot of this non-current debt has to do with just the overall expansion of this Disney Plus service. But we can see this most recent quarter they did take a huge jump in non-current debt. The quarter before, which ended in March, had $42 billion in non-current debt. Right now they have about $54 billion. And remember, they report earnings this upcoming Thursday, I believe. Now, if we take a look at cash and cash equivalents, they have about $23 billion in cash, which is not that bad, especially for a business that's still probably positive in cash flow right now. But like I mentioned, Disney is one that has some sector outside of it. Another one in this market is Six Flags. This one's up 17.65%. This is ticker SIX. And now let's take a quick look at their cash flow business. We can see Disney has not been affected that much when we're looking at cash flow from operations. We see this huge decline right here and let me try to zoom in. We see this huge decline of revenue in the most recent quarters, but cash flow from operations has not really taken too much of a hit. In their most recent quarters, they were still profitable in cash flow. They were still positive cash flow from operations. Similar story can be said to free cash flow. The third sector we're going to take a look at is the restaurant business. And here I'm going to take a look at Texas Roadhouse. This is ticker TXRH. To all my podcast listeners, year to date, this business is up actually 41%. So that's pretty impressive. That's actually better than some tech companies out there. And this is impressive because it means that Texas Roadhouse was one of those businesses that were able to kind of adapt with the overall market. And right now it is up 10% compared to for the day. So congratulations to anybody holding Texas Roadhouse. Another one will probably be Shake Shack stock in the similar market. But let's take a look at how Texas Roadhouse has been affected. And we can see they did report their most recent earnings, which ended September 30th, and revenue growth was down 3% compared to the same time last year. So they are picking back up, and I can see why stock prices is actually up compared to the same time last year. They have seemed to kind of adapt with the overall market. Their worst quarter was a quarter ago, which ended in June 30th. Revenue growth was down 31%. So for a second, it looked pretty scary for Texas Roadhouse. And at the beginning of this pandemic, it was down about -5%. Before that, it was actually growing at almost double digits, high single digit values. And before this all started, it actually grew 20% in the quarter that ended December of 2019. Next, I want to see how their margins are going. This most recent margins, they still showed profit margins, and they showed a healthy gross margin as well. So Texas Roadhouse is doing pretty well. And now with more places opening up, I can see how this might benefit even more. Let's take a first look at their shareholder equity. Shareholder equity, very similar to Disney, has not been affected much due to COVID-19. It actually seems like it hasn't been affected at all. So that's pretty good. It means they're not really grabbing on too much debt. And what we can see here is they did increase a lot of debt in the past few years, but not much in the past few quarters. And if they did, it's because they have built new property, plants, and equipments that has seen a huge gain up here. So that means they're just building more restaurants. They're just updating these restaurants and buying more property, plant, and equipment. And if we take a look at their cash flow from operations, let's take a look at quarterly. Right now, they are still profitable in net cash flow from operations. So yes, it did look like it took a hit thanks to COVID, but that revenue shot right back. So I can understand why this market why Texas Roadhouse is doing amazing. So right now, another one in this market would be QSR. This is Restaurant Brands International, and I think they own Burger King and Popeyes. Some other market, this one's up 8% compared to the same time last year. All right, so that's it for the three sectors. And if anybody is interested in these sectors and not in individual stocks, one that a lot of people talk about is Jets. ticker JETS, and this is a big ETF for all the airline industry. Then there's another industry, PEJ, and let me just zoom in so you guys can see. This one is a small blend equities ETF that a lot of people talk about. Is the Invesco Dynamic Leisure and Entertainment ETF. Here you have like Hilton, you have Domino's, Walt Disney, you have Texas Roadhouse, Grubhub, a lot of the industries that have been affected by COVID situation right now. All right, so now my thoughts. First, it's better to understand my overall investment plan. When I invest in companies, I don't buy companies just because there's a certain trend going on, right? The business I invest are businesses that I believe will grow in any scenario, in any presidential, in any administration. So the companies that I own, I believe are going to do good in both pre-COVID and post-COVID. I'm not going to go and buy new businesses because I believe they're going to do amazing post-COVID cure. I think would probably be the best thing. So if I don't have these businesses right now, it's not, and let me say, it's not for any bearish reasons. It's just not businesses that grab my attention. Sure, airline business, I do believe, is probably one of the industries that might end up back to its previous levels in the future years. But again, it's not there. The technology there, the advancements is there. It's not something that excite me. And I believe jumping in and out of trends is probably the worst thing to do, right? Just a few months ago, the clouding stocks were the trend, right? And we saw all-time highs, and people were buying at these all-time highs. I did buy a dollar cost average, so I did buy a bit on all-time highs, but I also bought way before the market was trending them. Unfortunately, what ends up happening is people end up buying all-time highs. Now, some of these stock prices have dropped down in these clouding markets. People are going to sell those and believe that these are going to be the new trend. So now they're going to buy these new trends. Who knows? They might buy them at the all-time highs, and then that cycle continues until you're broke and have no money. So for me, just be careful, understand where you're investing your money and why you're investing. If the only reason you're investing in this company is, hey, they're going to do amazing now that COVID is done, maybe it might work, maybe not. But for me, those are not reasons for me to invest. But anyways, I could be wrong. So good luck to anyone investing for those reasons. And let me know if you guys want me to hit 3 other sectors so we can see how the market has reacted due to COVID and how much of a hit they have taken. So take care, guys. Have a good night and see you next time.